start off in the green, and we are well in the green. We were telling you that implied opening, which is spot on. Let's run you through the big gainers today. The starts in the green. HDFC Bank is up 1.5%. You have Hindalco as well. That's up and about in today's trading session. And giving it company on the upside is Tata Steel as well. So the Nifty Bank is off the blocks in style. Remember, the last couple of trading sessions, it's been losing its way. But today, at least for starters, it's up close to around 200 points or thereabouts. What's not doing well? HCL Tech, only 0.5% lower. Just take a look at that. The pre-positioning is something that's helping them because the market was net short. The stock was down 8% getting into the numbers. And it seems the shorts are covering out a little bit because it's down only around 1%. And make no mistake about it, those numbers were disappointing on all parameters. TCS as well, the start was mildly in the green. So that stock as well should come up for you on the screen. TCS is up 0.7%. From the broader markets, plenty of action. And as we speak, the number of stocks that are advancing are nearly around 1,600 stocks in comparison to 300 stocks that are declining. A few more stocks in the broader markets. Kolte Patil, well, their sales volumes numbers came out. That was up 30%. And Prestige as well. Pre-sales up 30%. I think both those two stocks reacting positively. But Sonia, tell us more.
Okay, good opening, right? And this despite weak numbers coming in from HCL Tech. TCS as well was slightly lackluster, but the market has moved on and putting on some weight. It's almost a 100-point gain on the Nifty now, trying its best to hang on to that 19,500 mark. It's largely global-led, so the moves from the US market have been very strong. You've had cooling off of US inflation, so the view is that perhaps one last rate hike and then the market will sort of move on. HCL Tech is now down 1.5%. So clearly the management commentary, the earnings, the fact that margins have been under a lot of pressure for HCL Tech is something that has not gone down well at all. Remember, HCL Tech's EBIT margins have fallen 130 basis points quarter on quarter, and that is, that's not a small amount. And also the fact that the management spoke about a lot of, subdued moves and weakness in the BFSI, communications, in the high-tech space. All of that has led a bit of weakness for HCL Tech. For TCS, as we were telling you earlier as well, there's no negative surprise in TCS. So the stock actually is holding up about 1.5%. The market is bought into that. But all in all, you'd have to say very, very good start to trade. The Nifty holding on to that 19,500 mark. And no better time than to get Atul Suri into the studio here with us. Atul, hi, good morning. This is a market that's firing on all cylinders. I think the last time we met, we were talking about 18,000, 17,500, and since then it's been, zooming.
Absolutely.
But what now? Do you think it has more legs?
I do think so. I mean, I have been sharing this target earlier also, 21,500, which sets it about 12% or so from here. So I think that if you look at this market, there is a lot of skepticism, but I think that's quite misplaced. If you look at it, this is a global repair that's happening. It's not just Indian markets. 2022 was a difficult year, more so for global markets, which are more tech-driven. And what you are seeing in 23 is nothing but a repair of that. And that is happening across the globe. I mean, we look at US, etc., S&P 500, whether it's Dow, transportation, NASDAQ, all at 52-week highs. And they've made a lovely, sort of bottoming pattern. But there are some pockets which we've kind of forgotten about. Look at Europe. But you'll be surprised how well European markets are doing. In fact, a lot of markets there are at lifetime highs. Look at Japan. It is at a multi-decade high. So what you are seeing, Sonia, is a massive repair job that's happening globally. So that is something that is the first point that gives me sense that, hey, it's not one-off. Remember, late last year, we were the only market actually making highs and all were making 52-week lows. And that party didn't last. But when you realize that there's breadth, global breadth, I think it gives the thing a lot more legs. Number two is if you look at the internals of the market, you'll feel sectors. It's very broad-based. It's not one or two sectors that are driving it, whether it's your banks, whether it's your local infra, plays, NBFCs. There's a lot of breadth that's happening. Barring one or two very niche sectors or segments, the whole market as such is doing very well. So there's immense breadth. And third, I think why India is very special is that there's something called 52-week highs, which we are seeing across the globe, but there's something called lifetime highs. And there's a lot of difference between them. Lifetime highs is what you call blue sky territory. Because there are no resistances, theoretically, that means that everyone whole stock is in the is positive, right? I'm talking at an index level, not at a stock level. So essentially, you don't have very disgruntled investors or people who are willing to sell at a certain level. So lifetime highs have their own momentum. So that's why this, target that I'm giving you about a 10 to 15% kind of move, which is global in nature. And I won't be surprised if India does better than that.
So, if you just want to match it or tie the global setup in, how are you feeling about that? Because now we've reached a stage where inflation has cooled off in the US. The expectation is that we could see just one more rate hike and then it's done.
Right.
At a time like this, how do markets generally perform?
See, I think the interesting part is that if you look at things like especially bond yields, I think that is so important. It really taught us the importance of the venom in the tail actually last year. I mean, that just took off and everything, all the risk on asset classes were down. So I think that is one area which I look at very closely. So that had almost like the last few days, it had kind of spiked. But post yesterday's data, there has been a bit of a dip. So I think as long as US bond yields remain below 4, I think that there is a good case that the risk on trade can sort of play out. Also, what you should see is what's happening in the dollar. The DXY, which is a very good representation, is also off massively. It is at a it's about that 100 level. So what is happening is that there is a feeling of confidence that is coming in. Whether there will be one hike, two hikes, those are all, I think, semantics. But the fact is that people do get a sense that we are at the end of the cycle. And the good part is that growth is not getting smashed. It's not getting hammered. The issue is, are we going to have a hard landing versus soft landing? So if you keep raising rates, inflation cools off, and growth doesn't get, sort of killed, I think that's a fantastic Goldilocks scenario. And that's what the market is factoring in. The quantum may change, one decimal here and there, changes narrative a lot. But I think that's the kind of thesis the world is playing out with, which is a very good setup for India. And as I said, that in this whole scenario, what's happening is that India is definitely emerging as a standout. And you can see the kind of narrative also that is being played out, I mean, forget Indian media, but even if you look at global financial media, you'll find that for the first time, India is finding mention, which it is sort of, I think, well deserved in the past, but never got it.
Well, hi, Atul. Always good to have you. And, it's always good when a party is on, right? And It's a global party, as you mentioned. But India's got its dancing shoes on. And perhaps we're the best dancer, at least as of now. Well, if you're going to be going to around 21,500 odd, who takes us there? I mean, the Nifty Bank will have to perform. Any, constituents that will lead us towards those levels?
Definitely, Bank Nifty is something you can't ignore because that has so much weightage. It tends to, sort of lead things.
Yeah.
And whenever rallies happen without banking, it's always dicey. But the good part is, as I said, it's very broad-based. But what I think is going to change this year, or already has changed, and which a lot of people are still in denial of, is that the themes or sectors that are playing out are domestic in nature. In 2017, 18, 19, 20, it was generally those few select quality stocks which are more export-driven, your IT plays, your pharma plays, and things like that. But what I feel is that there is going to be a massive shift that is happening, and the themes that are playing out are domestics. So that is why in our portfolio, we find that we are extremely overweight electrical equipments, capital goods, engineering. And remember that these are sectors which have been forgotten for a decade. They did nothing.
Yeah.
They are under-owned. And my memory, if it's right, when these themes or these sectors play out, you see that the move is not about 6 months. You have to go back between 2003 and 2008 and see that when these sectors move, I mean, my models tell me that it's almost a revival of the capex cycle. And if that plays out, these stocks do very, very well. And for us, the litmus test is going to be the quarterly numbers are coming out. So we will get a sense that, hey, how good are these companies going to do? Well, a lot of people are concerned that they've run up too much and the valuations are too high. And the question is, should you take profits? But I think that they are going to actually surprise on the upside. I think the profitability will surprise on the upside. And that's how these themes and sectors play out. Nobody knows the end game. Nobody knows what they'll do 3-5 years. But ultimately, it's quarter after quarter of outstanding beats, good guidances, which really help and create longer term trends. And I think that the trends are here. And I feel that they will surprise on the upside.
So, Atul, hi, morning.
Morning.
Just tell us the next HAL, and I think, then we won't ask you any more questions.
I wish I knew. I wish I knew.
No, just
Nobody knows. And I tell you, if somebody says they know, they don't know.
Then they don't know.
Yeah,
okay, makes us feel a little
Nobody
better.
knows. I tell you, this market is not. It's like Lego. If you see the kid play a Lego thing, it's all blocks. They are building blocks. Like 10 years later, this will happen, that will happen. I'll tell you, we can't predict 10 days later. The important part is it's a process. And the process is a Lego block building process.
Yeah.
Companies will deliver numbers, the prices will move, trending earnings lead to trending prices, and that is what it is. If I say I know what's going to happen 10 years later, I'm fooling myself.
That's the beauty of someone like Atul, that humility is such a huge thing, right? You've been through so many market cycles.
I think the markets made you humble. Yeah.
So okay, on a jokes aside, but on a slightly more serious note, because you're so optimistic about this part of the market, industrials and capex, and we do have, at least I have very clear memory of what happened between 2005 and 2008.
Right.
People don't know how to wrap their heads around this.
Right.
Because whether it is industrials or whether it is stocks now in the electronics manufacturing space, a lot of these are very small companies, small caps, mid caps, your Sirma, Keynes, and some of even Cyient DLM, the new listing.
Right.
40 times forward multiples, 50 times, and you see these stocks go up on a daily basis 10 to 20%.
Sure.
So first instinct is this is going to come down bad. It's just human tendency, right? So you might have a big miss happening there. So how do investors wrap their heads around this and get ready to play this big cycle?
I mean, what is a perfect PE? Is 30 PE good, 20 PE good, 50 PE? It's all linked to growth. If the company grows and gives you beats, all these things get justified. Yeah. All these things get justified. And if you have all these high PE stocks which don't give you that level of growth, they get battered. So ultimately, it's all, as I said, these are Lego building blocks. You will only come to know in the future. I will show you many companies which are 70 and 80 Ps and have gone to create, in fact, the biggest wealth creators in the country were never cheap. The biggest wealth creators were never cheap. They always, and every time people kept cribbing and cribbing and cribbing. But the fact is they kept delivering numbers. And the moment you do that, it gets justified. And remember, we are using historical, right? Forward, we don't know. If the beats come, suddenly these things keep getting adjusted down. And
So don't let PE scare you when you're talking about capex and
I guess it's not a very simple number that you can look at it in a very linear fashion and you can divide it across the market for all stocks. Every company has its dynamics. I think PE is more of an art.
Okay.
It's not a science.
The
it's
science
not a number.
and art debate.
It's not a number. Like EPS is a number, right? But PE is something
abstract.
Okay.
Yeah.
Well, one space that you got bang on was autos. I mean, I remember you telling me last year that, the space to be in is autos. And since then, the stocks have been flying.
Sure.
But do you think there's a lot more upside now? I remember you saying that not so much in the frontliners, but it is the, broader markets, the ancillary stocks that you like.
Yeah.
But even the frontliners, I mean, an M&M is up 30% this year.
Yeah.
Do you think the best
But
is
the
over?
common thing, Sonia, is electric mobility.
Yeah.
If you look at all these companies, even in the front line, even the ancillaries, wherever the touch of electric mobility or promise of electric mobility is there, you'll find that the moves have been stellar. Stellar. Some in the small and mid caps are like disbelief. They've beaten what IT stocks did. So I feel that if you can, even in auto, because it's such a big theme, your frontline stock, ancillaries is such a big universe. If you're able to identify the theme of electric mobility, I think that is where you find that there's a lot of interest.
It's not too late to get in.
Absolutely not. Yeah. Absolutely not. Like in my portfolio, I have a large exposure, but to auto ancillaries which have an electric side to it, and substantial. I think that those have done very well. And again, it's not global. It's not just happening in India. It's not that we are gone out of the whack or we are doing stupid. It's happening globally if you really see. There's a lot happening. This can dramatically change a lot of things, So that's why I like that theme. And in that theme, specifically, because ultimately, you have limited bullets.
Yeah.
You can't really buy 100 stocks. Yeah, you have to buy 2 or 3.
Yeah.
So I think electric mobility and also maybe premium biking, right? If I look at a Bajaj.
That's for rich people like you.
Bajaj or
all these fancy
Biking shoes.
Yeah, biking shoes, bikes. And I see him whizzing in the streets of Bandra, like on all his fancy bikes and his fancy
He's
Jordans.
contemplating between a Harley and a Triumph.
And wearing the latest Jordans that,
Absolutely.
He's got the
moves, he's got the look.
Speechless. Nigel is
He's into
speechless.
jewelry,
Nah, I'm just saying, says someone who's living in Pali.
He's into jewelry, you see. Premium bikes and Jordans.
I mean, just to clear the air, just one bike, but I'm hoping to get the other one.
But a connoisseur knows, one connoisseur knows another.
No,
There you go. Thanks, Sonia. Back me up. But, Atul, getting back to the markets, a couple of things that have worked out. And you were saying cooling of commodity prices are very positive for India. Yeah. And Brent crude prices, well, it refuses to actually crack.
Absolutely.
It's back at around $80 per barrel.
Right.
What kind of levels are you looking at on Brent? And as well as the dollar index, you briefly spoke about it at the start of this conversation. Yeah. Is that headed much lower? Because these are going to be two big positives for India.
I totally agree. In fact, commodities is something which I really watch, very closely, because definitely they are raw materials, and we know how profitability gets affected of these companies. We saw that last. And crude really is not just a demand-supply game. It is total politics, and it's actually cartelization. And if you look at the way the Saudi is at it, they are like determined to do whatever is to keep prices higher.
Yeah.
So Brent, as I understand it, or as I look at it, it's stuck in the 70 to 90 kind of range. I would have thought Brent would be closer to 65 or thereabouts. It had come to 70, and I felt at that stage it's fallen, but it's back at 80. So I think commodities, I have a feeling that we'll have to live with the fact that commodities are not going to be as sedate or as in a secular downtrend as they were a few years ago. I feel that commodities are going to have their ups and downs. And I think that to some extent it is also good and justified. If one asset class gets pushed very far down, it leads to excesses or pullbacks, which is what we experienced in 2022. So commodities do have a rightful place. It was something that's ignored. Today it is not ignored. And the fact is that I think even like the rates that we saw, like 120 crude, etc., are not justified. But maybe what we saw where crude had almost gone into negative also is not justified. So I feel that a range of, I would say, where we are from 70 to 90 is good enough. We'll have to live with it. Ultimately, you have to pay for them, and you need to have more investments. So I think this has been a very big reality check, a reality shock, where the whole ESG thing had come out and all commodities were, considered polluting, etc. I think that there's a major reset. So commodities are not going to crack. They will create heartbeats, murmurs, but I don't think it's going to create heart attacks.
Okay.
Atul, finally, leave us with the thoughts on technology and IT, because something very interesting is playing out. Yeah. Companies are posting absolutely flat growth. They're saying demand environment is uncertain, some cancellations, but stocks are not falling. Even today, TCS is up, HCL Tech is hardly down, 1.5%.
Right. So I think this is, again, tech is a very important sector. See, after banking, in terms of weightage, tech is probably the second highest. Maybe energy is there or somewhere there. So from that point of view, tech is something that cannot be ignored. But the interesting part is that if you look at tech in the index, there are these 3-4 large players. But if you look at the mid-cap space in tech, there's a lot of action happening. So for us, personally, we don't own any of the large-cap tech stocks, but we do play or participate in this mid-cap space. And we feel that there's a lot of stuff that's happening there also. So for me, tech as it stands today is probably the large cap. Let it settle down, let the trends emerge. But there are definitely very good trends in some select mid-cap IT spaces. So I think you can participate through them. And there also you'll find that whole auto, electric, autonomous cars and all that tend to be, again, a theme that's running. You can't really pin it down. But that seems to be a bit of a theme that's playing out.
Okay, just summarize for us. You said that 21,500 is your target, right, on the upside.
Right.
But has the base for this market also moved higher? I mean, the last base was around 16,000, 17,000.
Right.
Has the floor moved up?
Yeah, so see, first thing is the immediate flow becomes your breakout level, which was, 18,800 or thereabouts. So the fact is that when you broke into lifetime highs, you broke above that. So when a breakout happens, it is very normal for markets to come back and test. So a 3 to 4% kind of correction in the index is
par for the course.
It can happen anytime. I mean, it can happen tomorrow. But the thing is that we feel that ultimately nobody can time these things to perfection. A lot of people, the basic question, Sonia, today is that, okay, if most people who missed this thing, should you deploy now? Is it too late? I think it's a good time to deploy. The fact is, if you've deployed later, the market's got a little expensive. Some sectors and stocks got expensive. No, I think they're going higher. And third is, should you wait for a correction? Yes, a correction will come. Definitely will come. But can you time it? Who can get a 3%, 4%? It's great for an intraday trader or a short-term trader. But for most investors, it's not going to matter whether you invested at 19,400 or 18,800. So I think 18,800, for a short-term point of view, becomes a very important level, because that's the breakout level. And markets do test it or get somewhere there. And if that holds, I think it's fantastic.
Okay, all right, Atul,
Thanks.
as always, pleasure having you
Thank
here
you
with us.
very
And
much. Thanks, Ravi.
I hope the two of you go riding together in Bandra.
He's a celebrity. He's a
So
band
are
guy.
you.
I didn't know
So
Atul,
are
you're a
you.
biker?
I'm not a
Not a biker. No, not a two-wheeler.
Maybe you can
I
learn.
own two-wheeler stocks.
That's a better, that's a better
That's
way
a
to
discussion
create
for another time.
It's a non-depreciating asset.
Thank you. Thank you very
Thanks a
much for
lot.
joining
Thanks,
in.
guys. Thanks.
Okay, well, with that, I think we have to shift focus to our next corporate conversation. So let's just talk about the next company in focus. And we're looking at Coromandel. Now, the incessant rain in several parts of North India have resulted in both loss of life and property. We actually have Jayashree Satagopan, President, Corporate and CFO at Coromandel International, to just get a sense of how this is playing out. Thanks, ma'am, for joining in. Good morning. Let me first start by understanding whether you at Coromandel have seen, I really hope everyone's doing fine at work and at home. Do tell us, in terms of business, has there been any disruption that you have noticed, given the rainfall in most parts of the country?
Good morning. The rainfalls have just started, and as you know, that there are certain parts in the country where we've got excessive rainfall, certain parts where the rainfall is still at a deficit. At this point in time, our operations have not been impacted, and our people are all safe.
Okay, the operations have not been impacted. That's great to hear. And good to know that everyone is safe in your office, I'm sure at your home place as well. But just wanted to understand what's happening with the agrochemical space, because, you know, the big headline is that globally a lot of agrochemical companies have issued profit warnings. There are talks of a lot of inventory issues. There's pricing pressure as well. Can you explain to us what exactly is happening? When you talk about pricing pressure, what do you mean? How much has it impacted your own business? And how much do you think your own profitability could get hit?
Well, what we've been hearing and what we have been reading about the agrochemical industry per se is true. There are a lot of pressures globally. Having said that, you would also recognize that we are in a silent period, and therefore any questions that relates to specific segmental performance, we may probably take it after our quarterly results.
Okay. Ma'am, I just wanted to ask you again, you know, it's great you told us that your operations have not been impacted, but I also wanted to get a broader sense on the business. Because of this rainfall, I believe sowing has been impacted in different parts of the country. So would that not possibly affect the market, the expectations in terms of demand, pricing? How should we read the sowing trends and therefore the impact on your business?
See, the sowing trends in some parts have been impacted because of excessive rains, but then the company has its presence across the multiple states. As I said initially, there have been parts where we have deficit, there are parts where the rainfall is normal, and there are parts where we have seen excessive rainfalls. Our main markets are in the south, and the rainfall has just begun and started with a good trend. So again, it's early days, because after a delayed start of monsoon, we are seeing some green shoots coming in. The acreages of main crops like paddy and cotton were lower. Paddy is picking up. So there are mixed signals that are coming in. But more or less, when I look at it across the country and our key geographies at this point in time, things seems to be pretty much okay.
All right. Hi, good morning, ma'am. You know, globally, many agro companies, they've issued profit warnings. There have been talk of inventory issues, demand pricing as well. Give us your sense on India. And are we seeing higher dumping coming in from China?
I think the situation in India is also being grim overall. We've seen that the price reductions have happened over the past, I would say, couple of quarters, and the channel inventory also seems to be on a higher end. So those are the things that we are witnessing in the Indian market per se.
Okay, so can you tell us a little bit more about the raw material prices? How much lower are the raw material prices, and what has been the impact on product pricing? How much, you know, what do you think the way forward could look like in terms of raw material prices?
The raw material prices are expected to be soft. That's the indication that we get from the markets that we operate in.
So can you give us some numbers when you say expected to be soft? How much could it be? How much could they fall further in the quarters to come? What could the impact be on your business?
So we clearly do not have an indication how further down it can go. Obviously, in China, the production capacities have been higher. They have started production, and possibly there's a bit of dumping that is also happening. And that has obviously resulted in the raw material prices coming down. What we understand from the sources with whom we interact, that this trend is likely to continue and the raw material prices could remain soft in terms of the next couple of quarters. What it could do to the prices, it also depends upon the ability of the companies in terms of where they source from, at what prices they source from, which are the markets they are competing in, whether it's domestic, export, so on and so forth. So it is going to be company-specific outcomes. And it is overall from a country perspective, we will see that lower raw material prices are there, but each company will have its own strategies in terms of addressing these situations.
Fair enough, Ms. Satagopan, but can you kind of just quantify that even roughly in terms of how much is the drop, say, over last year or sequentially over the last quarter? An average, I mean, 10%, 15%. So we just understand the raw material situation and to what extent there is that cushion now available.
So as I was mentioning earlier on, we are in a silent period, and anything which is specific to the company's performance is something that we do not speak until the results are out.
Okay, all right. So we are
able to appreciate that as well.
Absolutely,
Sure,
ma'am. We appreciate that, and we look forward to chatting with you post the results. And then we'll get more numbers. But let's talk about a couple of other aspects. You have been investing in startups. The recent one being you've increased your stake in Daksha. What is the idea with regard to this drone setup? And also, could you tell us, are you looking to take this stake to around 100%? More rationale on this particular acquisition, this startup. Go ahead.
Okay. As you would have noticed in the last year and a half, the company has been looking into the startup space, especially on the technology front and agri-technology. Last year, we had made 3 investments. One of them was in the drone startup, which was Daksha, where we initially started with a 10% stake, and in April of this year, we had increased it to by another 8.5% or so. So at this point in time, as the company is maturing and it offers opportunities across various applications, starting from agriculture, which is where Coromandel has a dominant presence, and then beyond, where you can look into defense, logistics, surveillance, training. So we think that this technology foray will mark a significant opportunity and step for Coromandel to expand beyond its core operation. And even in agriculture, if one were to look into it, drones are going to play a dominant role as we go along when it comes to applications in the fields. One, it is precision agriculture. Second, it is also going to help where labor availability and costs are going up. Similarly, there are opportunities in the logistics space, surveillance space. So Daksha has been a early startup. They have done very well for themselves.
Sure. Could you give us some numbers just to understand? I mean, it's great to see, right? Precision agriculture is the way forward, and we're seeing a lot of companies invest there. So how much could your efficiency improve because of this? How much would costs go down? As you said, it will reduce labor costs, etc. Any numbers that you can share with us, and also any other such technology or new innovation that you plan to invest into in, say, the next 12 to 18 months?
So as far as agriculture is concerned, a couple of years back, Coromandel started working with another company in terms of piloting and seeing how it actually benefits the farmers. We had done extensive field trials, and based on those outcomes, the overall productivity of the farmers went up by around 20 to 25%. So I'm not talking in terms of the companies, but in terms of the end users, which are the farmers. And this was done at a pilot scale. Today, the company has procured few drones, and through a Grow More Drive program, we are driving it across the APTG, Karnataka regions with our Grow More stores. So hopefully in the next 5 to 6 months' time, as these drones are being deployed, we will be able to get much more results. But definitely there is a benefit for the farmers. As I said, the past results show us anywhere between 20 to 25% productivity gains overall for the farmers.
Okay, all right. Thanks a lot, ma'am, for stopping by and giving us all of those details. We look forward to having a chat with you. Post your results. We'll get more details. And in fact, we'll talk about some numbers as well. For the time being, we'll slip into a short break. On the other side, we'll get chatting with Kamal Sarda, the Director and CEO at IFGL Refractories, to discuss their expansion plans. Stay with us.
Welcome back. Well, what a powerful session it's turning out to be. And this is what we were discussing in the morning, that today the setup was fantastic for the bulls to go out there and, bat on the front foot. We've got fresh all-time highs for the Nifty and for the Sensex, and a lot of sectors are participating. IT, interestingly, seeing buying. Look at TCS, look at Infosys. HCL Tech seems to be, the market's mind is that it's right now more of a company-specific issue. But the other stocks are roaring away. There is Reliance that's joining in. Banks are charged up. So, guys, like we were discussing that, I think after a couple of dull days, today was the day, and at least for now, it's powering through.
Oh, absolutely. I think it was just a matter of time before the market sort of got on back to a new high, right? And honestly, I was feeling a lot of FOMO last week, a couple of weeks ago, when the market had hit new highs. I was like, when will that time come?
So
I'll be sitting
get that new
in
high
the
today.
studio. And of course, for all the bulls as well, it is celebrations galore. Once again, new highs there. And the money has been coming in from foreign investors, right? Thick and fast. In July already, we've got 11,000 crores in. So I guess that's where the push is coming in.
Well, it had the ingredients of a good session. I think in the first 30 seconds of the show as well, when we started, we said it's going to be a good day.
Absolutely.
The dollar index was weaker. You had positive global cues. And the IT stocks, how much of the bad news was in the price? Look at HCL Tech's numbers. It's down only 1%. It should have been down 5% odd. But pre-positioning seems to have played its role. And TCS in the green as well. So good tidings. We're trading well in the green. And the Nifty has made fresh all-time highs. But let's talk about a couple of stocks in this week itself which were buzzing around. IFGL Refractories, well, the company received an approval to set up a new manufacturing facility for continuous casting refractories. And that will have an installed capacity of around 240,000 pieces per annum. To understand more about this and the reason that the markets are quite excited, you pull up a last 1 week chart, you'll see that the markets are excited because of this capacity expansion, and also there was a promoter settlement that came about. Kamal Sarda, the Director and CEO at IFGL Refractories, joins us on the show. Hi, Mr. Sarda. Good morning. Thanks so much for joining in. Well, we wanted to understand a couple of aspects with regard to this expansion. One is, how do you fund it, this 150 crores odd? What's the revenue potential? It's normally around 1.5 times, I think so. So could you tell us what is the revenue potential? And by when do you think you hit this peak revenue potential?
This project cost is estimated at about 150 crores. and this will be partially funded from internal accruals, and I think we will also take some loans against this. Could be about 60-70%. That we have not decided. And the revenue potential is about anywhere between 150 to 200 crores, depending upon the market, and it will take about 3 to 5 years to reach to the full capacity. And the reason why we have decided to set up this plant, one is to give in one of the best technology plant. Our existing plant is slightly old. So now Odisha is a steel buzzing area. We are talking about about 100 million metric tons in the next 7 to 8 years. And that's where the refractories are. We feel our refractories will be needed. And these are all like high-grade steel capacities coming up. So you need a very high technology products. And backed by this, our technology center at Odisha will also play a big role in giving the best quality products to the customers.
Got it. Got it. All right, Mr. Sarda. So the geographical reach out there is going to be good for you. And as you said, around 200 crores in the next 3 to around 5 years. Give us a couple of more details. What is the ROCE on this particular project? If you could tell us, what are you looking at? And also, since you're saying, they're talking a lot about higher value, better value products, is this margin accretive? And I ask this because your margins have been improving. So what could be the rough margins on this particular capacity that you're setting up?
So this product range is because it's a high-tech product, definitely the margins will be higher. And we are talking of roughly around 15 to 20% ROCE. And with this, this definitely will help us improving our overall margins of the company.
Okay, 15 to 20% ROCE, got that. Can you tell us, in terms of the future for this particular project, is it largely for the domestic market? Are you looking at the export market in a big way? And if yes, can you just elaborate on that?
No, this project is primarily for the domestic market, as we are this plant in Odisha, and which will be closer to all the steel new capacities coming up in Odisha. And for the export, we already have a plant in Kandla.
Okay, so can you tell us a little more about the export market potential? You do supply to places like Europe and America as well. And the growth has been pretty good. If you look at it both in Europe and America in Q4, the segmental revenue, there's been a decent jump. What kind of overall growth are you looking at for FY24?
I think some of these figures, I think growth for FY24, I'll not be able to share right now because of the silent period. But I mentioned in my last interview with you that we are talking of doubling the turnover. That's our target in the next 5 years' time. And we are moving towards that. And this plant is also one of the trigger point for this incremental growth.
Okay. All right. Mr. Sarda, the problem is that as of now, you traded a big discount in comparison to the other listed peers, Vesuvius as well as RHI. So that's why the street is a little bit more optimistic on your prospects from here on. So holding on to these margins and doubling your revenues will be key. We don't have too much brokerage coverage, but we have a smaller brokerage, that's Monarch, that has said it's a potential re-rating candidate. That aside, you've told us enough about this particular project. I want to ask you about Kawasaki, their stake in the company. Now, they had close to 15.5% stake. You all have said there's a breakthrough over there because the existing promoters will buy that 15.5% stake. Is there any kind of technology, technical support that you all used to get from this particular entity that was a promoter entity earlier? And when them going out of the picture, do you all lose anything or is everything as normal?
So everything will be as normal. Kawasaki had acquired Tata Refractories in somewhere in early 2010. Yes. And thereafter, there was no technology transfer. I think last technology transfer, if I'm not wrong, was 2005. So since then, we have been developing our own technological improvements. So we don't feel any effect because of that. Okay. And acquiring the shares of Kawasaki by Mr. Bajoria and his family, I think shows his confidence in the company.
Okay. How does he fund it though? Will he have to pledge the existing stake that he has?
No. I don't think he's going to pledge anything existing, but he has enough cash with him, and I think he is fully prepared to acquire this without pledging any of the existing IFGL shares.
All right, so we'll leave it at that. Thanks a lot for joining us. I appreciate your thoughts. That's IFGL Refractories. But the big headline at the moment, undoubtedly, is the market. Fresh record highs coming through for the Nifty. 150 points in the green for the Nifty. And let's remember that this is on the back of very strong global cues as well. Most global markets have been rejoicing the fact that the US inflation has softened significantly compared to what the street was expecting and compared to what we saw earlier. And that could perhaps mean one last rate hike from the US Fed. You never know. There's still a lot more data to come through. But the expectation is that the last of the Fed hikes could come through in the next meeting, and then perhaps softening of the monetary cycle. And that has given rise to a lot of risk appetite across global markets and in our own markets as well. So that's the big headline. But let's continue to track the individual pockets. There is the pharma sector that we're looking at this morning. Analysts are expecting around a 10 to 12% revenue growth and margin expansion for the pharma and healthcare companies this quarter. Let's start with pharma companies where growth is expected to be led by new launches in the US. Let's toss across to Ekta for more on that. Ekta, over to you.
Thanks for that. Well, yes, I'll start with the mother market, the US. The US could grow as much as around 10 to 12% for some pharma companies year on year this quarter. Growth could be led by sales of key drugs offsetting facts such as price pressure. For example, cancer drug Revlimid generic for the likes of Dr. Reddy's as well as Zydus Life. Generic Prezista for Lupin, biosimilars for Biocon, and specialty drugs such as Ilumya for Sun Pharma. Lower sales of albuterol, which is an inhaler, and US FDA issues at Cipla's Indore unit could weigh on the company. Now, moving to domestic formulations, growth will continue to be driven by factors such as price hikes and better volumes. Estimates are around a 10% growth on a year-on-year basis. The likes of JB Chemicals, Eris Life, and Torrent will be aided by recent acquisitions such as Sanzyme and Oaknet and Curatio, respectively. Margins are expected to improve as much as around 50 to 70 basis points on a sequential basis and as much as 3 to 4% year on year for some companies. Now, margin improvement is going to be led by factors such as sale of key drugs in the US, lower raw material and freight costs year on year. Talking about margins, watch for Divi's Labs and Laurus Labs. The street is anticipating as much as a 300 basis points Q-on-Q margin improvement due to better gross margins for Divi's. Laurus Labs, another story. It could continue to be weighed down this quarter after it reported a multi-quarter dip in margins in Q4. Otherwise, API companies' revenue will be aided by improved demand year on year. Commentary on Lupin's launch of Spiriva generic, Sun Pharma's guidance on clearing the import alert at Halol, and Aurobindo and Gland's outlook on injectable sales in the US will be watched. Lastly, for healthcare companies, hospital revenues are expected to grow 12 to 13% year on year, aided by as much as around 50 to even 500 basis points improvement in occupancy as elective surgeries and international medical tourism aid year on year. Max is likely to lead on revenue and margin improvement. Apollo Hospitals' profitability is likely to be dragged lower by losses in the 24/7 arm. For diagnostic companies, expect high single-digit volume growth in patient volumes. Margins could stabilize Q-on-Q but remain under pressure year-on-year due to competitive intensity. Let's, as always, leave you with a quick snapshot of pharma and healthcare companies in terms of an FY24 PE, the likes of Aurobindo, Lupin, Cipla, Divi's. Remember, a lot of these companies have seen significant run-ups. On the diagnostic front, Dr. Lal's and Metropolis. And for hospitals, it is EV to EBITDA for the likes of Max, Apollo, which are the more expensive ones, and Fortis Healthcare.
Okay, thanks a lot, Ekta, for that. Well, let's do one thing. Let's slip into a quick break. On the other side of the break, we'll get talking yet again about the markets and the fresh highs that the Nifty has hit this morning. More on that with Mitesh Thakkar. He'll give us some technical trades. Do stay tuned in.
Welcome back. Well, the market's up and away with the fresh highs on the board, and it's picking up some serious momentum now, 150 points higher on the Nifty. So let's bring Mitesh back in to figure out what the trades should be like now. Mitesh, so it's all about the bulls this morning. You tell us, longs on the index, Bank Nifty, both, and then let's get down to stocks.
So it's about the bulls and also about the fact that the Nifty has made a fresh high. So between the two indices, I think Nifty is looking stronger in the short term. So from a trading point of view, I would want to have a long on the Nifty. One can keep a stop loss just below levels of 19,480, which is roughly about 60 points lower from here on the Nifty spot, and hope for a target of around 19,700 to begin with, and then eventually maybe even higher. So stay long, stay positive. On the stock side, I have two metal names on the buy list today. Hindalco, disclaimer, we have some futures positions over here, so vested interest. But that's a buy with a stop at about 429 for targets of 450. And sale is something which I've recommended earlier as well. Even now looks good to me. That's a buy with a stop at about levels of 18.5 and a target of around 94.
Okay, well, seems like all the favorites are coming back on the buyers list now. So a lot of stocks hitting fresh highs this morning. Electra Green Tech is at a fresh high. That's up about 5%. You have Zomato, that's up about 5.5%, fresh 52-week high there, and a couple of others as well. So good time. Mitesh, thanks a lot for joining in. A good time to talk about some more stocks. Then Nimesh is with us to give us the standout brokerage report of the day. Nimesh, over to you.
Hi, sir. So today's standard is on Voltas. Another downgrade coming in. So this time, Bofa Securities has downgraded the stock to underperform from buy. So technically, it's a double downgrade, and they've cut the target price to 781. Now, they see multiple headwinds to the UPC business of Voltas, which contributes 70% of the overall revenues. Now, the headwinds are largely because one, this quarter the sales will be much lower because of unseasonal rain. So that's one impact. Second, they're struggling to regain the market share which they've lost. So they've lost 400 basis point market share in the last 4 quarters, and even the margins have now come sub 10%. So they are at 8-9% versus historically 13%. And they delayed profitability in the joint venture business, which is Voltbek. So these three are the key reasons why they've downgraded the stock to underperform now. And they've actually, the target price cut is largely because they've cut the multiple as well for the UPC business from 30 times to 25 times. So over a time now, there has been a lot of downgrades on Voltas. This is the last one. But do remember the stock has already corrected so much, so not big impact on the stock. But further, caution view on Voltas, and this time from Bofa Securities.
Okay, thanks a lot for that. Well, Samvardhan Motherson is the other stock that we're looking at this morning. It's up almost about 3% There's a Jefferies upgrade that has come through on Samvardhan. It's upgraded the stock to a buy from a hold and raised the target price to 115. Now, they say after 4 long years of tough earnings, Samvardhan's operating performance has started to improve. So they've upgraded the FY24 and 25 EPS by 18 to 42%. They expect a strong growth led by the improving core business. And they also talk about how the 2 recent acquisitions that Samvardhan has made will perhaps result in higher revenues for them. So they made 2 acquisitions, which was SAS, and they also bought an 81% stake in Yachio's 4-wheeler business. And Jefferies says that these 2 acquisitions together can add 15% to SAML's FY25 revenue. So they're very bullish there on the stock, and hence, it's looking like a good showing this morning.
Okay, well, 3% and counting for now on Samvardhana. But let's get back to the story of the day in terms of the corporate action. And that obviously is TCS. We've got Rima joining in. She's had a busy morning talking to the management. So Rima, you tell us. I think the market's verdict is very clear. Not perturbed because it's on expected lines. But what are the big takeaways for you?
Well, I think that's the big takeaway, right? That it's been predictably slow. It's been subdued, but the street was anticipating that. There are no big negative, nasty surprises like we'd seen in the case of Q4. So this has largely been in line with expectations. Undoubtedly, it's still been a weak quarter. There is no growth. The top line growth has been flat. Year-on-year revenue growth has come down to single digits after 9 consecutive quarters of a double-digit growth. Margins have fallen by 130 basis points, impacted by the wage hikes. But here, it's worth noting that TCS is perhaps amongst the only IT companies where the wage hikes have been given as per normal on 1st of April. Most other companies are deferring their wage hike. HCL Tech has announced that there is going to be no wage hike for senior employees. The TCV is a number that the street is going to like. For the second consecutive quarter, the total contract value, TCV stands for total contract value, which basically means your order wins, new and old, renewal. That stands at more than $10 billion. And this is higher than the company's quarterly run rate, in a way, a guidance of $7 to $9 billion. There is weakness in BFSI, communication, and high tech, and as of now, the management is not calling out any recovery in H2. They're saying things are still very uncertain and fluid. JP Morgan has been bearish on the IT pack. They have an underweight rating, further lower the target price to 26.50. They believe the valuations at 25 times forward multiple is on the higher side. Nomura reduced rating, target price 2,800. They think it will be difficult for the company to achieve the EBIT margin, of 25% by the end of the year. But on the other hand, you've got Bernstein with a target price all the way to 3,650. So they're quite bullish. And Jefferies is neutral with a hold rating. Back to you.
All right. Thanks a lot, Rima, for that. So that's the word on TCS. But let's go across to Surbi. She has some very interesting stocks with her. Anand Rathi has done very well, post its numbers. Dream Folks is also on her radar. Surbi, over to you.
Thanks so much for that. So Anand Rathi has reported its Q1 numbers and they're pretty strong. The revenue was up 21% sequentially. The PBT was up nearly 19%. There's slight dip in margins, but not much of a concern. Margins have come in at 40% versus 40.5% in the previous quarter. Now the operational metrics are strong as well. The number of active client families are up nearly 5%. The net flows in private wealth is nearly up 3.5% sequentially. The trail revenues, that is up 6%. And the number of relationship managers is up 5% at 308. Now that number was stagnant in the last fiscal, so that is going up as well, so that's positive. And they have laid out their FY24 guidance and they have achieved 27% of their guided revenue, which is 661 crores. So 27% of that has already been achieved and 26% of their net profitability for FY24 also has been achieved. Some positive coming for Anand Rathi Wealth. Next on my radar is Dream Folks. Now the company has formed a strategic partnership with Plaza Premium Group, that is to expand its global lounge network. Now the collaboration will see an inclusion of over 340 premium lounges in over 70 international airports, and with this Dream Folks will have touch points over 1,700 now.
Okay, all right, got that. Surabhi, thank you very much for all the details over there. And with that, we do have to take a very, very quick break. We'll come back on the other side with a special segment. It's The Economy. Today, Lata connects with Vishal Goyal of UBS Securities as well as Shantanu Chakrabarti of BNP Paribas for the outlook on the banking sector.
Welcome back. Big day for the markets. What with inflation looking like it's taming down in the US and the Indian growth numbers yesterday from IIP coming good. A great combo of good growth and lower inflation. The world is in a Goldilocks scenario and we are leading it with fresh all-time highs. But let's get to the result season ahead of us. The first of the banking results come out today, Federal Bank. And in 4 days, the merged mighty HDFC Bank will announce numbers. The US inflation numbers are indicating the Fed could be one and done in terms of hikes, and falling bond yields, or rather rising bond prices, are always positive for banks. For a preview of the quarter and the outlook for the banking sector, I have with me two experts, Vishal Goyal of UBS and Shantanu Chakrabarti of BNP Paribas. Both of them well-known banking experts. Thank you, gentlemen, for your time. Vishal, first up, let me start with what could have been a worry. Margins. Do you think that we should see margins coming in 10 to 20 basis points lower for most of the banks?
Yes, that's the expectation. Clearly driven by cost of deposit hikes. If we look at the data from RBI for May, there was a 30 basis point increase, like 35 bips actually increase in cost of term deposits, while the lending yields increase now have moderated down to more like 10 basis points.
Okay, fair enough. What's your take, Shantanu? Is this going to impact all banks equally, or will there be some winners and losers?
Right. So, Lata, I mean, as Vishal was pointing out, the incremental repricing of deposits is obviously a cost factor. And most of the floating rate increases are, of course, in the rearview mirror. But some banks have a greater defense in terms of margins, purely on account of the kind of asset mixes that they run. Say, I mean, banks like IndusInd, AU Bank come to mind, who are incrementally adding at a fairly fast clip, thanks to the cyclical reversal, fairly high yield fixed rate assets. So to that extent, they are in a better position to defend their margins. But having said all of that, for most banks, I would agree that margins are at or near peak and some moderation is to be expected this quarter onwards.
Oh, okay. Yeah, so those with high risk, high return yields or kind of assets, maybe more SME, like perhaps IndusInd, are at an advantage. Vishal, what is the view going forward? Do you think we are going to see continued pressure on margins simply because the giant HDFC Bank has to replace the maturing HDFC deposits or HDFC liabilities? So they will be hungry, and if the big boy is hungry, he pushes up costs for everyone?
So, yeah, I think that has been the expectation even for last 6 months. And but I think converse to the expectations, what we saw, that there was a fairly disciplined approach on deposit gathering by almost the entire industry. And the interesting data point which actually has come through in May is cost of fresh term deposits is very close to the cost of back book, which means it's not putting any more upward pressure, especially for private sector banks I'm referring to. It's not putting any more pressure on the overall cost of term deposits for the private sector banks, which was definitely not expected given what you just mentioned about the the need for more deposit from the merged entity. So I think my sense is incrementally, clearly there is more pressure of refinancing that would keep markets slightly higher than usual rates you would have seen in previous cycles. But I think given that there is a large part of market, which is the wholesale market, which has not been yet tapped by any of these entities, you may not see any significant pressure, for the system.
Oh, that's a very big medium-term positive if that is the case. And going by the inflation numbers in the US, it does look like perhaps there is a cap on yields. We went to 4% in the US for what, 1 or 2 days, and now back at 3.85 on the 10-year. Let's talk growth, Shantanu. Are you convinced that the growth pace can be good? We saw a 16% system growth last year for a few months, and now it's come down to 15. So I guess that was base effect last year. So will growth be an issue, or will it just plateau at these levels?
Right, Lata. So if you look at growth, from a demand perspective, it is very hard to raise a question mark on the growth rates, because yes, the corporate offtake has been low for a lot of the prominent banks, but with a lot of the SME ecosystem moving along, retail, especially within that unsecured demand remaining high, there's no obstacles as far as asset quality is concerned, no concerns at all regarding the credit worthiness of incremental demand. So from demand perspective, there was never too much of a question mark on growth. The only concern that the market had at one point was because deposit growth in itself was a little slow, and LCRs were gradually moving down for some of the larger banks. Then was there to be a supply side concern? Now look at the numbers as they have shaped up in the last month or so. Even adjusting for the fact of demonetization of 2,000 rupee notes, you'll realize that definitely deposit growth has moved 100-150 basis points higher than what the run rate was for the best part of last year. And partly it's because there are downstream impacts of credit growth. If we have been running at a heady credit growth for the last 12 to 18 months, it is to be expected that at some point the downstream impact on deposit growth is also going to come through. And that's what you are seeing. And since the system deposit number is a much larger number than what the credit number is, 12 is enough to finance 15. And therefore, I don't see too many risks to growth either from the demand or supply side.
So it will be what, high teens for the bigger banks, for the better banks, so to speak, stronger banks?
Right. So
will it go to 20?
At a system level, if we are looking at low to mid-teens kind of number, then the larger banks should be scoring 300 to 400 basis points higher, which is what our assumptions are. Then there are one-off cases like Kotak Bank, which is scaling up a specific part of its portfolio and is therefore needs to and probably would be growing a little higher. Some of the specialized asset class banks will also be growing higher. But for the most of the large prominent private banks, therefore, 18% kind of growth could be doable, 17 to 18% kind of growth for the full year.
Okay, got that. Anyway, I mean, just as an aside on the deposit issue, I'll tell you, every banking economist or even central banker will tell you every loan creates its own deposit. So this fear is more a margin fear or more a cost fear. Not really. Amount of deposits is never an issue. But Vishal, the big gain all the past, 8 quarters at least, has been credit cost falling like no tomorrow. Sara nichod diya, or is there more to be gained on credit cost?
I think, we've already squeezed it 2-3 times. So it seems we should be already ended the benign part, which is because a lot of recoveries also has helped, right? The credit cost numbers. And for maybe select banks, you might see some more decline in credit costs who could not participate in the last 1 year in the range. But if you think about incrementally next 1 to 2 years, 2 or 3 things should drive it up, not again maybe higher than averages, but at least towards the average. One is the sheer proportion of unsecured book now in banks' balance sheet is now higher, which, the credit incidence is anyway higher on that book. So that would start to add to credit cost. As the recoveries also slow down, that also will, then the gross slippage will, have a bigger portion going into net slippage, and therefore the credit cost should slightly increase. There is no big structural issue right now on the corporate side. So that is why, one can still be relaxed. You should see gradual increases through more from the retail side.
Okay. Credit cost. What's but your medium-term view is still good. I mean, you are talking about margins kind of getting capped, and you're talking about credit cost gains receding. What's the overall view is still positive on banking at the current prices?
Yes. Yeah, I think, absolutely. I think if you look at, again, when I say overall, you also look at 20-year history of Indian banking, right? And I'm sure you've seen that. We've never had such low leverage in last 25 years. It was only last seen in, I think, 2005 or so, if I look at the corporate leverage. Plus, I think you have rates now also starting to decline. So we are not entering into a hiking rate cycle. So that also gives you some more room, in terms of expanding credit or consume. I think we should we should remain constructive overall. You can be selective among stocks, etc. But I think sector still looks pretty benign.
Okay. Well, I know you are not allowed to talk stocks, but your your reports are running for the viewers. And I think HDFC Bank is among your buys, Indus is among your buys. Well, let me toss this to Shantanu. Shantanu, your buys are also running. Why are you guys keeping off PSU banks? Look at the rally of the past year. All triple-digit rally. Any one PSU bank you take, the rally is more than 100%. You're not convinced that they should enter your buy list?
So, for example, SBI is one of our preferred betas. Now, Lata, what I would like to point out is also in this quarter, SBI is one of the prime candidates for earnings surprise. I mean, just a while back, you were alluding to the fact that if on margins, you guys are somewhat lukewarm and credit costs are all done, then where is the growth coming from? Please remember that in last year's numbers, at least in the first half, there is significant mark-to-market losses in some cases and small ones in most of the cases. And the first half of the last financial year also didn't see a very high disbursement rate. So the fee traction in the first half of last year is also weaker than what you're going to see currently. So through other income also there you're going to find a little bit of earnings growth. And on that, on that theme, probably SBI is going to surprise you in the quarter. Okay. So there's no such, block, so to speak. But why doesn't make it the top pick list? Firstly, because, probably HDFC Bank, ICICI Bank, these are looking better to me. But also the fact that in something like an SBI, one has to keep in mind the long-term track record as well, apart from the, the short-term fundamentals. And therefore, whether the market at any point in time would value it purely for its current fundamentals or structural cyclicality, which is kind of endemic to the business model.
Got it. Okay, there are structural and cyclical. A very quick one-line answer only, Vishal. Do you think that there can be a continued tactical rally in PSU banks?
Possible, because as I said, we are in benign cycle. And generally in benign cycle, you would see cheaper valuation and higher risk, generally franchise doing better.
All right. Sorry, out of time. But gentlemen, it's been a pleasure speaking to both of you. Shantanu, Vishal, thank you very much for joining in. And I think there are great takeaways for a viewer as well, for an investor. SBI will be the surprise, is what BNP Paribas is saying, that it could be a 100% rise in profit or even more. With that, we wrap up on Bazaar on the positive note that we continue to be at all-time highs. Chartbusters will continue to enjoy that moment. Stay tuned.